Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, macro developments, sector trends, and investment themes shaping the day. Today is Tuesday, May 12, 2026. We're Elena and Marcus.
So, today, consider yourself the third voting member of our investment committee.
Yeah.
Because we have a very specific mandate for this session.
Right, we're deconstructing that really abrupt end to this 6-week equity rally we've been seeing.
Yeah, driven by this massive dual inflation and energy shock.
Exactly, and we're going to dissect the technical unwind in highly concentrated semiconductor positioning, plus analyze this completely surprising resilience we saw in the credit markets today.
Because ultimately, we need to extract the exact so what for your institutional portfolio strategy. We are getting past the headlines and tearing right into the underlying plumbing of the market today.
Absolutely. So let's just set the table with the macro data that really triggered today's sudden risk-off posture. Because we essentially got hit with a decisive stagnation light signal. U.S. core CPI printed at a hotter-than-expected plus 38 basis points month over month.
Which is, that's the highest core inflation reading we've seen since June of 2022.
Yeah, it's sticky. And you have to pair that domestic data with this massive surge in the geopolitical risk premium.
The energy side of the shock.
Exactly. WTI crude spiked 4.25% today, closing at $102.24 a barrel.
Wow.
And this isn't just noise. It's directly tied to escalating fears that the U.S.-Iran ceasefire negotiations that they're collapsing.
Right, which brings severe disruptions in the Strait of Hormuz right back onto the table.
Oh.
And when you combine sticky, accelerating core services inflation with a localized energy shock like that.
The interest rate complex is always the immediate casualty.
Always.
The duration math is just unforgiving. So the 10-year Treasury yield naturally gapped up to 4.45% today.
Yeah.
And equities reacted exactly how the textbook says they should. The S&P 500 closed down 16 basis points to 7,401.
But the real carnage was concentrated in long-duration tech.
Right. The NASDAQ 100 took a much heavier hit. It dropped 87 basis points to close at 29,065. And look, if I'm looking at this strictly fundamentally, this is standard repricing, right? A higher for longer rate environment simply crushes the terminal value of those long-duration tech cash flows. The narrative that the AI CapEx juggernaut is, completely impervious to macro headwinds, it just finally met reality today.
Well, hold on. I'm going to push back on that.
Okay, why?
To say this is purely a fundamental duration repricing, that's missing the real story here.
You don't think it's fundamental?
No. An 87 basis point drop on the NASDAQ from a 38 basis point inflation bump, that's totally disproportionate. To understand the severity of that underperformance, you really have to look away from the discounted cash flow models.
And look at the market plumbing instead.
Exactly. This wasn't just fundamental. It was a violent technical unwind of some really spicy flow dynamics.
Ah, right.
Institutional research flags have shown that investor sentiment has been pinned in this stretched territory for 3 consecutive weeks now.
So the vulnerability wasn't just the valuation.
No, it was the leverage. You have to look at the sheer volume in structured products right now.
Because retail has been just aggressively piling into the ETF complex.
Right. We are tracking nearly $100 billion in levered semiconductor ETF assets under management right now.
$100 billion. Wow.
Yeah. So you get retail momentum traders and institutional factor trades all crowded on the exact same side of the boat.
The actual fundamentals of tech earnings suddenly don't matter as much.
They become completely secondary. The mechanics of these levered products dictate that they have to rebalance their exposure daily. So in a declining tape, they become forced, price-insensitive sellers simply to maintain their target leverage ratios.
Right. It's like, think of market makers like the shock absorbers on a heavy truck, right?
Okay, I like that.
Normally, their job is to provide liquidity, smooth out the bumps. But right now, because of how heavily levered this entire ecosystem is in these semi-ETFs, the shock absorbers have essentially inverted. When the market hits a macro pothole, like today's hot CPI print, instead of absorbing the shock, the market makers are mathematically forced to slam on the gas.
Right. They have to short the underlying stocks just to keep their own books delta neutral as prices fall.
Exactly. It creates this reflexive doom loop.
It's the perfect analogy. So any macro headwind acts as the spark for a forced liquidation event. It's an emotionless, algorithmic unwind that is entirely divorced from actual cash flows or, EBITDA revisions of the semiconductor companies themselves.
So capital is fleeing highly levered speculative tech due to rate sensitivity, sure, but primarily due to these forced liquidations.
Exactly. And the critical question for your portfolio allocation now is, where is that capital hiding?
Well, let's follow the money, right? Because if you look at the secondary markets and the divergence in market breadth today, the contrast across the indices was stark.
Yeah, it really was.
The Russell 2000 got absolutely crushed, down almost a full percent, 97 basis points to 2,843, which makes logical sense.
Oh, totally. Small caps carry heavy floating rate debt loads.
Right, they're inherently sensitive to the cost of capital, so they're incredibly vulnerable to the 10-year yield spiking to 4.45%.
Yeah.
But then you look at the Dow Jones Industrial Average, and it actually managed to grind out a positive close, up 11 basis points to 49,761.
And that divergence is just the textbook definition of a defensive rotation. I mean, the capital fleeing those speculative high beta growth names isn't just sitting in cash.
No, it's actively seeking a haven in defensive value.
Right. Industrials, companies with highly visible near-term cash flows that don't rely on cheap borrowing.
But wait, while that equity rotation is completely logical, the signals coming from traditional safe haven assets today present a massive glaring anomaly.
Yes, the commodity and FX action.
Right. This is where I'm genuinely confused, and we really need to scrutinize this cross-asset narrative. Because if geopolitical risk in the Middle East is escalating to the point of a ceasefire collapse...
And we're actively talking about blockades in the Strait of Hormuz.
Exactly. Historical precedent screams that there should be a massive bid for precious metals.
Right.
Yet gold actually slid 1% today to roughly $4,689 an ounce. And even Bitcoin, which is so often touted as, the modern non-sovereign store of value.
Yeah, Bitcoin dropped 1.4% to $80,635.
So why is the ultimate geopolitical safe haven selling off during a severe geopolitical escalation?
It comes down to one overwhelming force, honestly. The U.S. dollar and real yields, the DXY, the U.S. dollar index, strengthened by 40 basis points today to 98.35.
Wow.
We're seeing a scenario where the combination of surging real yields, which is driven by that hot core CPI print forcing the Fed repricing,
right,
alongside absolute dollar strength, is simply overpowering the geopolitical fear bid for precious metals.
Because it's all about opportunity cost.
Precisely. Gold pays zero yield. So when the risk-free rate on a real inflation-adjusted basis spikes the way it did today, the opportunity cost of holding a dormant asset like gold becomes prohibitive for institutional managers.
Even with tanks massing on a border.
Exactly. If you can lock in a 4.5% risk-free yield, you drop the gold and buy the dollar.
So the currency markets are basically driving the commodity pricing here. They're isolating this energy shock as purely supply-driven rather than, a symptom of broad fiat currency debasement.
Yeah, and institutional flows are absolutely corroborating this.
Yeah.
Major dealer desks are currently showing massive, concentrated long USD positions.
Favored against what?
Primarily against currencies like the Swedish krona, the British pound, and the euro. The FX market is basically pricing in absolute U.S. exceptionalism on interest rates, while Europe and the U.K. contend with much weaker growth profiles.
Okay, so that logic holds firmly for foreign exchange and basic commodities.
Right.
But if we follow that exact same thread into the complex credit and volatility markets, the signals go from anomalous to highly contradictory.
Oh, we have to talk about the VIX paradox today.
It is a striking disconnect. I mean, despite the equity sell-off, the hot inflation data, the rate spike, and the geopolitical energy shock,
The volatility market didn't just remain orderly.
it actually dropped. The VIX decreased by 212 basis points to 17.99.
And it gets weirder when you look at the credit market. Because while the 10-year yield is rocketing up, and the Russell 2000 is down almost a full percent, high-yield credit spreads actually tightened today.
Wait, they tighten?
By 4 basis points down to 308. And leveraged loan 3-year yields saw spreads tighten by 1 basis point.
I need to stop you there, because this looks like absolute delusion to me.
It does, right?
Are the credit markets just being dangerously complacent? We have oil breaching $100 a barrel and a hot CPI print threatening higher for longer borrowing costs. That structurally increases corporate default risk.
Yes, it does.
Yet credit spreads are tightening. I mean, that sounds like picking up pennies in front of a steamroller. It looks like a massive mispricing of risk.
I agree. On the surface, it looks incredibly complacent, maybe even reckless. But if you dig into dealer positioning and institutional hedging volumes, a structural explanation emerges that proves it isn't delusion.
Okay, so it's mechanics again.
It's mechanics. Prior to this specific sell-off, dealer gamma had shifted dramatically. In just 1 month, it moved from the second most negative on record to the 8th highest ever.
So market makers are broadly long options right now.
Exactly. And being long gamma means they are mechanically buying the dips and selling the rallies to remain delta neutral. That activity mathematically suppresses realized volatility.
Okay, so that explains the VIX dropping. But what about credit spreads tightening while the world objectively gets riskier? Why would institutional players bid up credit in this environment?
Well, here's the secret. They aren't necessarily bidding up physical cash bonds. You have to look at the derivative volumes. Major credit futures across Eurex, CBOE, and CME just hit their 100th percentile year-to-date volumes today.
Wow, 100th percentile.
Yeah, institutional players are aggressively utilizing highly liquid credit derivatives for their risk management and portfolio adjustments.
So they're trading synthetic index products to manage their exposure rather than dumping physical cash bonds in a panic.
Exactly, because dumping cash bonds would incur massive bid-ask slippage. This derivative usage provides immense synthetic liquidity to the market and actively prevents a blowout in the actual cash bond spreads.
I see. So it's essentially a controlled demolition. The lack of panic in the VIX and the stability in cash credit spreads suggests that at an institutional level, the smart money is treating this as an orderly, option-hedged equity rotation.
Right, not a systemic credit event.
But wait, for now, right?
For now, yes. There is a massive tail risk you must monitor here. We talked about that short gamma dynamic in the levered semiconductor space earlier.
Right, it's the forced selling.
If that forced selling accelerates and breaks key technical support levels, this broader market volatility suppression we're seeing could violently reverse.
Oh, because if the selling pressure forces dealers to flip from long gamma to short gamma across the broader indices,
The VIX won't just drift up. It will reprice instantaneously, and those tight credit spreads will gap wider in a matter of minutes.
which brings us to the ultimate so what for the listener. We need to translate this cross-asset data into a specific, actionable portfolio strategy.
Absolutely.
Because if you're managing money right now, you can't just stare at the VIX and hope the gamma pin holds.
No, you can't.
Analyst consensus across institutional desks points to a stark reality today. The anatomy of the equity market is currently very different from the anatomy of the real U.S. economy.
Yes. The index-level performance of the S&P 500, which has been buoyed for so long by mega-cap tech, has completely masked the deep underlying strain in the broader economy.
We are seeing definitive signs of consumer exhaustion.
Deep strain. The consumer discretionary sector just suffered its worst day of underperformance in 4 years today.
4 years.
Yeah. If you look at specific companies, apparel and footwear brands like Under Armour and On Running, they're exhibiting extreme volatility based on a severe lack of margin resilience.
And that makes complete sense, right? If you are a consumer discretionary brand right now, you're getting squeezed from both sides.
Oh, absolutely.
Your input and shipping costs are rising because oil is at $100. But you can't pass those costs onto the consumer because the consumer is tapped out by 38 basis point inflation prints.
Right. So in this environment, asset managers cannot blindly ride the index. You have to build a strict barbell strategy.
Actionable step 1.
Yes, actionable step 1.
Yeah.
Actively manage the concentrated risk in the technology sector. This means taking profits in overextended tech positions. But, and this is key, don't just sell and incur the tax hit or, miss a potential bounce.
You use options.
Exactly. The most efficient institutional mechanism here is to use call options to overwrite those positions. You generate premium yield on the holdings while structurally reducing your directional delta exposure.
Right. And then actionable step 2 focuses on the other side of that barbell. Downside protection and inflation hedging.
Crucial right now.
You should be actively hedging against the potential for that sudden volatility reversal we just warned about. You do that using VIX call spreads. And concurrently, you must maintain long energy and oil exposure in the portfolio. Holding energy serves as a direct, positive carry hedge against both the geopolitical escalation in the Middle East and the persistent, sticky inflation that today's CPI data just confirmed.
Furthermore, I'd say even in a market heavily driven by macro factors and ETF flows, idiosyncratic alpha opportunities remain critical.
Like what?
You need to identify assets that offer defensive value completely independent of the rate curve. So, for example, Philip Morris recently benefited from newly cleared FDA guidance on their nicotine pouches.
Oh, right, the regulatory clearance.
Exactly. That event completely removes a significant regulatory overhang. It offers highly visible cash flows and defensive value in a consumer staples name that is fundamentally insulated from the discretionary spending pullback we're seeing elsewhere.
I also want to make a really crucial point regarding how we analyze these global events.
Go for it.
It is imperative that you maintain absolute impartial analytical rigor when assessing the macroeconomic impact of geopolitics. Whether we're analyzing the outcomes of the Trump-Xi summit or the nuances of the U.S.-Iran ceasefire negotiations, your focus must remain strictly on the fiscal implications. Institutional desks monitor these events purely for their direct impact on global commodity pricing, supply chain premiums, and sovereign risk.
The political sentiment itself is irrelevant to the portfolio.
Exactly. The focus is solely on the transmission mechanism to inflation and asset pricing.
Well said. Now, before we wrap up, there is a fascinating and somewhat provocative development currently circulating among top-tier quantitative desks that you really need to be aware of.
The narrative sentiment algos?
Yes. We are seeing the launch of new theme-of-theme strategies. These are long-short portfolios that are completely devoid of traditional fundamental analysis.
Which sounds insane.
It does, but they are driven entirely by artificial intelligence, parsing millions of unstructured media data points to extract narrative sentiment. They dynamically allocate capital based purely on the velocity and direction of narratives before the fundamentals ever even hit the tape.
That forces a serious reevaluation of standard operating procedures. I mean, if the market is increasingly dominated by algorithms that front-run macro shocks using AI-driven narrative extraction, you have to ask yourself, is traditional fundamental credit and equity analysis becoming too slow?
Right.
Are we relying on lagging indicators in an environment where sudden sentiment-driven gamma resets, like that brutal unwind we saw in semiconductors today, dictate the primary price action? It's a structural evolution that demands your attention.
It really is. So to summarize today's session, here are the 3 key takeaways you need to incorporate into your risk models for tomorrow's open.
Number 1.
First, inflation core pass-through is the anchor. That hot core CPI print of plus 38 basis points confirms that energy-driven inflation is sticky and is actively transferring into services. Tomorrow's PPI data release is the next critical confirmation point, so you must adjust your portfolio duration risk accordingly.
Got it. And second, semiconductor leverage risk creates extreme fragility. With roughly $100 billion concentrated in leveraged semiconductor ETF assets, the market is highly exposed to nonlinear short gamma selling.
Yes.
If momentum support breaks further, expect rapid forced liquidation that is entirely disconnected from fundamental valuations.
And third, the severe divergence between the consumer and technology sectors demands a barbell approach. The underlying economy is showing acute consumer strain that is not accurately reflected in broad index levels.
So portfolios must rotate?
Exactly. Execute call overriding to take profits in overextended tech and decisively shift capital toward defensive value, energy allocations, and structured volatility hedges.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color and cross-asset analysis.